Hi, I'm Mitch Ryan, and today we're at the beautiful Henry and the Fox on Little Collins Street, and I'm joined today by Phillips, our Executive Investment Property Advisor at the Hopkins Group. And today we're just going to have a quick chat about property investment, particularly tailored for a Gen Y individual or couple.
My property appreciates at a greater rate in areas closer to the centre of large population bases. So in Melbourne, I mean, you know where the most expensive property is.
Yeah.
You know, whether it's Albert Park, Toorak or whatever. But it's in those areas close to the CBD. It isn't in the CBD for residential property.
Just to clarify, you recommend Generation Y looking to buy their first property, look for the cheaper option in the apartment in urban areas of Melbourne?
You know, it's what John Hopkins refers to as an inner-urban equation, that people want the amenity that inner-urban offers, whether that's employment, recreation, sport, education. They're fixed in what they can afford to own, to pay as a mortgage or as rent. So what they compromise on is size. So you buy in those areas where capital growth is most pronounced. You buy in those areas that most people can afford to buy or to pay rent on, which is that spot between 400 and 700,000. Smaller property, because it's easier to maintain and manage. And then really it's, you need the property to be newer rather than older. The older the property is, the more likely it is that you're going to get unexpected bills for maintenance, etc. So if you buy something that's 60 years old versus something that's 1 year old, you need to have access to more funds to maintain that property. So that's one of the reasons why we recommend our clients buy new property. The ultimate of that is the off-the-plan option, which again can suit people who are just getting into the market, because you only have to come up with a 10% deposit now, and then you've got 18 months or so till the property's completed if it is off the plan. But I've got clients who've got 2 or 3 investment properties who still live at home.
Yeah.
I mean, I guess that's the ideal, as long as you like living at home, where you're not paying any rent, but you can hold a number of assets, because the after-tax cost of holding investment property in Australia is certainly a lot less than paying the mortgage. It can be done. You've just got to be prepared to do it tough, but buy the right property.
Yeah.
Because what you're looking to is buy a property that's going to grow in growth for 10 years, 20 years, 30 years.
You mentioned capital growth. Is that something that you would be looking for if you were purchasing your first property as an investment property?
Always.
Are you looking for rent? Are you looking for rent yield or capital growth?
What property investors look for is capital growth, as well as certainty of rent. We always encourage our clients to prepare themselves for a 3-week annual vacancy. So if you rely on 49 weeks rent a year, you can do your budgets on that basis. The right sort of yield, this return on capital as a percentage of the capital value, you should look for a return of about 4 to 4.5% per annum. And you also want the rent to grow over time as well, because there is an umbilical relationship between the capital value of the property and the rental return. And sometimes rent increases are like watching grass grow. They'll come down to your personality as a landlord. I mean, I don't increase the rents on the properties I own until the tenant moves out, and then I'll revert to market rent. So, in answer to your question, I mean, the return on your investment is made of rental return as well as capital growth. But you've got to resist the temptation for going for too high a rental yield. If you see returns of 6, 6.5%, 7% return, which would be very nice from a cash flow perspective, it immediately says, watch out, you're not going to get the capital growth. High yield, in fact, says that there's less demand to own that property. Because if there was more pressure on ownership, the value of that asset would be higher, the rent would still be what it is, but the yield's lower than if the capital value is here and the rent still is what it is. So I probably haven't made that clear, but certainly high yield says to me, watch out, you're very unlikely to get good, strong capital growth. But at the core of it, what you've got to try and do is acquire a property that's easy to hold. Sort of property where you know the rent is going to come in regularly, that you're going to have good quality tenants, whatever that means. But it's got to be a passive experience, because otherwise, if you approach this with trepidation and your worst fears come to fruition, and you do have vacancies or people trashing the place or whatever, then you're more likely to get rid of it. You won't own it for 10 years and 20 years and 30 years. And we've got an extraordinary opportunity in Australia to invest and to help create our own wealth that I haven't seen in any other country in the world. I mean, this much discussed negative gearing conversation. It allows us to get a reward for the risks that we take by investing in property. And all I can say is the more often you do it, you realise that it just isn't that risky. Buying a one-bedroom apartment or a two-bedroom apartment or a Victorian cottage, but they're just too expensive, in a really popular area where you know that if the tenant goes and someone else wants to take it, it's not too expensive to maintain, and that's why I go towards newer property where you can claim depreciation benefits that reduce the after-tax cost. And so for most people, holding an investment property after tax will probably cost them about $6,000 a year. So right at the outset, if you can afford that kind of after-tax cost, and it doesn't interfere too much with your lifestyle, then it's something that, I don't think can be bettered.
Steve, thanks so much for joining me. I've certainly taken a lot out of today. So if you have any questions, guys, and want to discuss maybe your situation in a bit more detail, make sure you get in touch with us at the Hopkins Group. Steve, thanks again for your time.
Always.
And we'll see you soon.
Thanks, mate.